Welcome to Business with Louis, the show where we explore the world of entrepreneurship and business concepts in a way that's easy to understand and apply. Today, we're going to dive into one of the most significant financial events of our time, the 2008 financial crisis explained. The 2008 financial crisis was a global economic downturn that started in the United States and spread to other parts of the world. It was triggered by a housing market bubble bursting, which led to a crisis in the financial sector. In simple terms, many people had taken out mortgages they couldn't afford, and when they defaulted on these loans, it caused a ripple effect. This concept is crucial in the world of business because it highlights the importance of risk management, regulation, and responsible lending practices. The crisis led to widespread job losses, home foreclosures, and a significant decline in economic output. Understanding what happened during this period can help us learn valuable lessons about how to navigate the complexities of the global economy. One key concept is the idea of systemic risk, which refers to the potential for a small event to trigger a much larger crisis. In this case, the collapse of the housing market had far-reaching consequences that affected not just the financial sector, but also the broader economy. Influential thinkers like economist Hyman Minsky have argued that financial crises are an inherent part of the capitalist system. Minsky's financial instability hypothesis suggests that periods of economic stability can actually create the conditions for instability, as people become more reckless and take on excessive debt. This idea is essential to understanding why the 2008 crisis happened and how we can prevent similar events in the future. Another critical concept is the role of deregulation in contributing to the crisis. The Gramm-Leach-Bliley Act of 1999 repealed parts of the Glass-Steagall Act, allowing commercial banks to engage in investment activities. This led to a culture of excessive risk-taking and a lack of oversight, which ultimately contributed to the crisis. Let's look at some real-world examples that illustrate the 2008 financial crisis in action. Companies like Lehman Brothers and Bear Stearns were heavily involved in subprime lending and suffered significant losses when the housing market collapsed. The failure of these institutions sent shockwaves throughout the financial system, leading to a credit crunch and widespread economic contraction. On the other hand, companies like Goldman Sachs and J.P. Morgan Chase were able to navigate the crisis more successfully by taking swift action to reduce their exposure to toxic assets and raise capital. These examples highlight the importance of adaptability, risk management, and strategic decision-making in times of uncertainty. So, what practical lessons can we learn from the 2008 financial crisis? First, it's essential to be cautious when investing in assets that seem overvalued or are rising rapidly in price. Remember, past performance is not indicative of future results, and just because an asset has been going up doesn't mean it will continue to do so. Second, diversify your portfolio to minimize risk and maximize returns. This means spreading your investments across different asset classes, sectors, and geographies, rather than putting all your eggs in one basket. Third, stay informed about economic trends and policy changes that could impact your investments or business. This includes monitoring interest rates, inflation expectations, and regulatory developments that could affect the financial markets. Finally, it's crucial to maintain a long-term perspective and avoid getting caught up in short-term market fluctuations. As my colleagues on Wall Street would say, time in the market is more important than timing the market. By taking a disciplined, patient approach to investing in business, you can increase your chances of success over the long haul. In addition to these tips, it's worth noting that the 2008 financial crisis has led to significant changes in regulatory policies and oversight. The Dodd-Frank Act was passed in 2010 to strengthen financial regulations and prevent similar crises from occurring in the future. While there is still debate about the effectiveness of these reforms, they have undoubtedly had an impact on the way financial institutions operate today. As we look back on the 2008 financial crisis, it's clear that there are many lessons to be learned for businesses, investors, and policymakers alike. By understanding the causes and consequences of this crisis, we can better navigate the complexities of the global economy and make more informed decisions about our investments and business strategies. In conclusion, the 2008 financial crisis was a pivotal moment in modern economic history that highlights the importance of responsible lending practices, risk management, and regulatory oversight. By applying the lessons learned from this crisis, we can build stronger, more resilient businesses that are better equipped to thrive in an ever-changing world. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.